ask questions as we go, because we're gonna skip around on topics. And it's usually better to ask a question about the topic we're on while we're on it. And then I'll just have the latitude to save that for the end, if we get too deep off the topic. So, anyway, but as we go, raise your hand and let me know how can I help. So, let's get to this. So these are our topics for the day. And so, they range in importance throughout, and I'm gonna spend less time on, I'll call it generic type things, and more time on the questions that not only real estate professionals have, but really anybody that's self-employed or in a service type business. So, anyway, so the next one after, yep, next one. Okay, so this is kind of a laundry list of all the things that people in your business would probably have. And so, I don't know if there's any surprises there really. When we get all the way to the bottom of the list, we talk about utilities and cell phones. Utilities that are deductible that I see a lot of times, maybe we forget about, is internet service. We are usually going to deduct now your home internet service on anybody that works, not only from their home, but really works anywhere, because none of us can function without the internet now. And so, and certainly, I mean, that's, in our business, everything's on the cloud. And so I don't know that's your business, but certainly when our internet goes down at our office, we go home, because there's nothing to do. So, anyway, yes ma'am, you have a question?
Yes, are we referring to what we can claim for 2025, or are we doing 25 and future offset?
Well, I'll mention if there's anything that I think is gonna be time sensitive. For the most part, now that we got the new tax law this year, many of the provisions were made permanent. The other thing I'll mention too and point out is a lot of the deductions and the limitations now are on inflation factors. That's something that Congress has been doing more and more and more, just so that they don't have to deal with the topic again. And so, you know, a lot of the I'll call it the limitations get outdated. One of them that we'll talk about is automobiles, and when we get to that, I'll kind of point that out. But everything's on inflation factor, and so when we look at some of these limits, I'm going to be looking back at the screen because I don't remember them anymore because they change every year now, and so they just kind of ratchet up. And of course, with technology, again, your business like our business, there's a lot of things that they're just on a computer. I don't really need to remember what the standard deduction is anymore. It's going to do it, spit it out on the tax return by itself, and it's going to do all the calculations and anything that I need to know. So, anyway, flip to the next one, if you could, please.
Can I ask a question?
Yes, ma'am.
With service items, things like Wi-Fi or cell phone and whatnot, which you're likely to use both for business and for personal use, are you supposed to apportion that, or can you just take it up?
So what's happened over the years, the technical answer is cell phones, computers, are all supposed to be business versus personal. Same thing we're going to talk about with automobiles. There's a business versus personal. What's happened over the years, of course, though, is the price of automobiles and using an automobile for anything has gone up and up and up.
Right.
Cell phones and computers, down and down and down.
Mm-hmm.
And so where that 20 years ago, my cell phone bill was kind of a big deal. Purchasing a cell phone used to be a big deal. I'm sure the first ones I had, I'll date myself, I won't date anybody else, but the first cell phone I got probably cost, I don't know, $2,000. And now they give them away. So, I've had no questions about that from IRS in the last decade about, oh boy, did we use our cell phone for 100% business? And so by and large, people take 100% of it, and I haven't had a question, but the technical answer is we're supposed to allocate between
Yeah.
business and personal. But the cost is just so de minimis now, it just doesn't draw my attention really. Same thing with your internet service at home, obviously, I'm looking up recipes if I'm cooking dinner and forgot what was included in my special chicken recipe. I'm gonna do that, and obviously there's a personal component to that, but same thing, I mean, internet service is, you know, $100 a month, it's not a lot anymore. And it is used predominantly for business, and it is my house, I don't know about all yours, but, so, automobiles, this is in your industry, this is always an important topic, always, something to be talked about, but the rules we're gonna talk about really go for anybody in business. And so, automobile use is something that is expensive, and it is something that IRS would pay attention to. And so, the big question is, you know, how do I get that deduction? And so there's really a fork in the road, and I'm either gonna go down the standard mileage path, and I'm gonna just simply keep track of my business miles, 70 cents a mile, and that's my deduction. Record keeping's a little bit easier because now I just need to keep my business miles. Doesn't matter what my total miles are, I just need my business miles, and calculate that. That 70 cents per mile includes everything except for interest. If I borrowed money to buy my vehicle, that interest is not included in that 70 cents. And there is a mechanism to go ahead and take that, a portion of that as well. But outside of that, everything is included in the 70 cents. Alternatively, I can take the actual expenses. Record keeping becomes slightly more complicated because now I gotta keep total miles, because what I'm gonna do is I'm gonna take a percentage of my automobile expenses as my business deduction. And so I've gotta know, I did 10,000 miles for business, I did 5,000 miles for personal, great, I can take 2/3 of all of the expenses associated with it. And so, and of course, the actual expenses are your fuel, repairs, insurance, registration, if you lease the vehicle, and then depreciation, and we're gonna talk about depreciation on the next slide. But obviously, to produce all of those numbers, my record keeping responsibilities go up. And so, I've gotta keep track of all those things. When do I choose? So I choose whenever I place a vehicle into service in my business. Once I pick a method for that particular vehicle, I need to stay with it. And so if I pick standard mileage when I buy a new vehicle, I'm standard mileage until I get rid of that vehicle. Go on to the next vehicle, I get my choice all over again. And so that becomes important when you have a big year. And it's not only real estate agents, but farmers and salespeople of all sorts are gonna have up and down years. And so, and in your business, you know, our clients in your business, that's probably more true of any industry that we deal with. You have good years, you have bad years. There's economic trends that make it more lucrative, that you're gonna make more commissions. And so a lot of times, we get the question, okay, I hit it big, I sold 3 $10 million farms this year, and my commissions are through the roof. And P.S. I need a new vehicle anyway, because I'm not one to chase deductions, and spend money just to get a tax deduction on something that I don't really need. But when I need a vehicle anyway, and you say, okay, how can I get a big deduction for this? And so, the way you're gonna get a big deduction, obviously on the standard mileage, there's not much variance there, it is what it is. But then when we get into the actual, you've got all those expenses, but now let's flip to the next slide. Here's where the big purchase can count. And so first of all, we have to figure out what kind of automobile and what limitation level I'm gonna be exposed to. And so we've really got the quote luxury car limitations, which of course in today's world, you know, every new car is a luxury car because of the costs and it's just been so high. But now we say, okay, well, we have the luxury car limitations, and then we go up one level. And going up one level means that my vehicle is over 6,000 pounds, gross vehicle weight. And so I get lots of questions about, oh, I can do this, I can do this. No, you open the car door, and the little tag inside the door tells you what the gross vehicle weight is. It doesn't matter that you put a toolbox on it. It doesn't matter that you put a cap on your pickup truck. None of that makes any difference. You open the door and you look at the tag, and that tells you whether you're over 6,000 pounds or not. When I get to 6,000 pounds, all of a sudden, I am not a luxury vehicle now, and I have less limitation. And so I can take up to $25,000 for Section 179. I can take, as we're gonna see, unlimited for bonus depreciation in the year that I purchased that vehicle. And so, and then, so that's gonna be, what is that gonna be? That's gonna be my average SUV. That 6,000 pounds has not been on any kind of inflation factor or increase factor. It's been 6,000 pounds ever since I can remember. And so it's not unusual when you start looking at SUV gross vehicle weights, they're just over 6,000 pounds. And so all the car manufacturers learned this a long time ago as well. If I can get that thing over 6,000 pounds, I've got a much bigger market. And you do. Yes?
Real quick question, can we actually go back, say if I bought my SUV 3 years ago and it's over a certain weight, can you go back and adjust your taxes accordingly?
So you can amend your tax
Amend
return to
it.
change your election.
And it's kind of standard for the last few years, the weight thing.
The weight thing has never changed, to my
Okay.
knowledge. And
So it's for almost every single year.
yeah, it's the same.
Okay,
Yep, same.
Thank you.
That number hasn't moved. A lot of these numbers move, that number hasn't moved. And so, and then of course there is one level further up than that, is I'm over 6,000 pounds and I have at least a 6-foot cargo area. Okay, so let's think about that. For those of you like me who drive a pickup truck, how long is the bed? Bed in my truck's 5.5 feet, it's not 6. So my truck is just the same as an SUV. If I buy a 6-foot bed pickup truck though, all these limitations go away. And they're gone. And so, so really, there's a purpose to driving the Ford F-250. They all have 6-foot beds. And so, anybody, maybe not in your industry, but every person in construction, there's a reason they have an F-250 and not an F-150. Because there's a 6-foot bed, and I don't have any limitations. And so these limitations are the luxury limitation dollar limits of what I can take. And so, again, if I'm looking for a really big deduction, the moral to the story is I need to go 6,000 pounds or more, because then I can take more. And now we have 100% bonus depreciation, which has come and gone. It started at 50 way back once upon a time. It went up to 75, and then it went to 100. Then it started phasing out. The big beautiful bill has put it up to 100%, quote, permanently. So what's permanently? Well, that's till, we change administrations and they break their own tax law. But for now, it's 100% bonus depreciation until they change the law. And so what's that say is, in the practical world, I'm looking for a big deduction. I'm gonna go out and buy a $100,000 SUV. I'm gonna be able to take 100% of it. If I'm 100% business, is it smart to be 100% business? Probably not in your business, probably not in my business. One of the things I like to say to clients when they're talking about deductions is, one adage I like to use is, pigs get fat and hogs get slaughtered. When you're in a service business like you're in a service business like I am, and we don't need a special vehicle that can't be used for personal purposes. I put 100% business use on a tax return, that's gonna draw some attention. Because how many of us actually use a vehicle 100% for anything?
Right.
None of us do. And so, You're gonna take that $100,000 purchase and I'm gonna ratchet it down by my business use percentage. And so if I'm 75% business use, then I'm only gonna get 75,000, I'm not gonna get 100,000. Likewise, all the rest of those deductions that were on the previous screen, I'm only gonna take 75% of them, not 100%. Yes?
If you had two cars, could you delineate and say one is 100%?
You can do, when you have two cars, you can do a lot of things. So I can have one car, I'll call it my main car, that I use actual expenses on.
Right.
But my spouse's car, you know, we use it sometimes, not all the time, sometimes. I might wanna use the standard mileage rate on my spouse's car. You might have taken that on some, like for example, if I go out of town for a conference or something, and my spouse is gonna go with me, maybe we're not gonna use the main car that I use all day, every day. Or again, if I'm using a truck or some kind of vehicle I like to carry things around in, you know, I got clients in your business actually that do some commercial properties. They always seem to have pickup trucks, and I don't know what they have in the back of those things, but there's stuff they take around with them when they're selling commercial properties. So anyway, the point is you can do that. And the other thing I can do as well is if I use two different vehicles, there's no limitation on how many vehicles. The limitation in the auto world is business use percentage. That's the key. And then a lot of people, I don't know how many folks here have an LLC that they work their business through. A lot of times people will ask me, you know, does it matter if I buy the vehicle in the LLC name or can I buy my personal name? And my experience has always been, even through audits, is with vehicles, it doesn't matter. What matters is the business use percentage. It doesn't matter if my LLC owns it, doesn't matter if it's in my wife's name, it doesn't matter if it's in my name. If we used it for business, we can take that business use percentage of all those expenses. Did I answer your question? I got
Yes.
looped around in a circle there a little bit. Okay, so anyway, is there any other questions about autos? Because that's in your world, that's a big deduction.
Mm-hmm.
Okay, all right, next one. Okay, so now travel. So first of all, let's define travel for tax purposes. For tax purposes, the definition of travel is very simple. I'm staying overnight. And so if I'm staying overnight, then all of those things become deductible. Do I have to be overnight for something like a taxi or an Uber? No, of course not. I can take that any time. But when we get down to meals, and we're gonna talk a little bit more about meals on another slide. So, but meals for travel purposes mean I'm staying overnight. I don't have a travel meal. In other words, I can't deduct lunch every day. Because, well, you know, I was away from the office. Well, no, that doesn't count. In order for a travel meal to be deductible, I've gotta be overnight somewhere. Which I'm sure in your world, like my world, don't do as much of that as you used to. You know, I'm in the midst of this is kind of in our world, the calendar, this is the continuing ed month. Virtually all of our continuing ed is in November now, because we're after tax season and we're before the start of the next year, and so this is when we cram all of our continuing ed in. And you know, once upon a time, before COVID, that meant the month of November I was on the road, traveling to all of these tax seminars. Not anymore. I travel into the office outside my bedroom. That's my travel plan now. And so, you know, a lot of this in my world is going away, and I suspect maybe in your world as well. So, next slide. Okay, so here's another hot topic for you, your industry, and everybody else's industry. Is what about meals and entertainment? When can I deduct them? Again, this is varied a little bit over the years, but conceptually, and we're going back to, I don't know, we're way back to the Clinton administration and their tax laws, I think, is when entertainment became non-deductible, completely non-deductible. And so then all of a sudden, all of the world, including us, started to pay attention, well, wait a minute, what exactly is entertainment? And what exactly is a meal? And what exactly is a meeting? Because all of those things have different limits, because entertainment, I get a 0% deduction. Meals, I get a 50% deduction. Meetings, I get a 100% deduction. So, examples of what's not deductible. So if I'm going to a concert, if I'm going to a baseball game, I'm going to a football game, that's not deductible. Entertainment facilities. This was very controversial at the time, but all of my country club dues, my yacht club dues, seat licenses. So if I don't know if there's any season ticket holders for the Ravens or here, but when I buy season tickets to the Ravens, I have to buy a seat license first, and then I gotta buy the tickets. And so the seat license is a facility cost. So what's a facility? A facility is the seat license at a ballpark. It is the country club, the real estate, that's an entertainment facility. A boat is an entertainment facility. And so the cost of the, I'll call it the asset, are never deductible. What happens at the entertainment facility can be deductible. I go take somebody to play golf, and we have lunch. And we talk about business at lunch. Okay, that's a meal. Can't deduct the dues, but I can deduct the meal. Same thing with the boat. I can't depreciate the boat because I take my customers out and entertain them. But I can take the sandwiches, I can take the beer, I can take the gas, I can take all of the things that went into our trip. I just can't take the facility. Okay, so, and then we get down to the bottom, and company party is the I'll call it the poster child of what is 100% deductible. And so the Christmas party, for us, once upon a time when we had a tax season party, but that's when, you know, we filed tax returns and we stopped when the post office closed. Yeah, well, everything's done online now, and IRS closes at midnight Central Time, so tax season ends at 1 o'clock in the morning for us now. We don't have a party anymore. But that would be an example of something that's 100% deductible. Or a meeting, this. If we had, this is the first time we haven't done this at lunch in a long time, but when we do lunch, we bring lunch in. Okay, well that's 100% deductible because we're pulling together for a meeting and we just happen to do it at lunchtime. And so that's 100% deductible. Likewise, I don't know if you guys do open houses, things like that, that you have refreshments for. That, in my mind, is 100% deductible. That's more, I'll call it a secondary part of the reason we gathered together. The main reason we gathered together was to talk about taxes. And so we just happened to eat while we're there. All right, next one. Another hot topic is home office use. And so what are the limitations on that and when does it make sense? So one thing I tell everybody kind of out of the gate is we're going to talk about this. What should be going through your head is, boy, there's a little bit of record keeping to do here. And same thing as an automobile, there's got to be an allocation. I got to gather up all the expenses for my home, and then I'm going to take a business use percentage. But we can only take the percentage based on the area that is exclusively, and that's a very important word, exclusively for business. And so I can't have a room where my computer is and that's where I work, and my kids have a desk there too, and that's where I have them with their homework. Not exclusively. Doesn't count. This is why there's no more bed and breakfasts. Because the landmark case in this area was about bed and breakfast, where the people lived in the house and then had rooms rented out. Well, it came down to actually it was a court case in California. The appeals court out there finally decided that, well, the exclusivity clause applies to bed and breakfast. And so that means the kitchen, do I make my own meals there? Oh yeah, I do. Not exclusive. The bathroom, Do I ever use the bedrooms for my grandkids when they come, when I'm not renting it out to somebody else? Yeah, no, that's not exclusive. And so, now by and large, from a tax standpoint, I'm either going to have a rental house, an Airbnb that is not a place I live and have any part of, or it's gonna be my house. There's not gonna be a mixed, because I'm not getting any deduction, basically. And so, that was a hot thing, 25 years ago? Bed and breakfasts were all the rage, and that just kind of pulled the plug on those. So, because I really got no deduction at all for that. You have to show a profit. In other words, if I lost money, of course, you're in the service business, I'm in the service business, and we don't usually lose money. And so that's not really a big thing for us. But then when you start to pull this exclusive area down, what you're gonna find with an office and a home deduction is, that's a lot of work for not much income, or not much deduction. And so, if you do have that situation, you can use it. Now, the other requirement is, I can't have an office available to me. Like I have an office in my home, and it is exclusive. My wife works with our firm, and we're the only two that live there. It's exclusive, but I have another office. It's not my only office. And so our main office is in Preston. I live in Easton. It's only 12 miles. And so I can't deduct an office in my home because I already have an office. Your industry, by and large, over the years has gotten a little bit complicated, because now a lot of the firms, even the bigger firms, have like flex space. Like, I don't have an office. I have space, I can go plug my computer in and I can sit there, but when I get up and leave, somebody else is gonna come plug their computer in and sit in the same place I did. Is that an office? I would probably say, no, that's not my office. I have space available, but I can go to the library and do that. Unless I have an office somewhere close, I would think there's some latitude there for you, that you might be able to take it. But again, it's not a big bang for the buck. Next one, please. Okay, so we talked a little bit about depreciation. So now for automobiles, now everything else. Okay, so what about everything else? And so there's a de minimis rule that came with, there was about 600 pages of capitalization regulations that came out of that 15 years ago. And of course, one of the things that has always been controversial in real estate, for example, is when do I have to capitalize? And what does that mean when I capitalize something? That means I don't write it off all at one time. It's something that's gonna last longer than a year. My computer, the life's getting shorter all the time, but supposedly they're gonna last at least a year. And at least at this point they do. The table, that's gonna last a year. This building is gonna last more than a year. And so whenever it has to be capitalized, then I'm going to have to depreciate it. And so what are my options when I depreciate something over time? So one of the big things of the capitalization regs was this de minimis rule, that I can make an election on my tax return that basically says, we're not gonna talk about this topic at all, IRS, if whatever it is costs $2,500 or less. And that's a single item. Like people say, well, my computer system costs $3,500. Well, it's not a system. You bought a printer, you bought a computer, I bought a routing system. You look at each piece of equipment, and even in the regulations, the example is, I bought 10 computers for $10,000. And so, okay, well, I bought 10 computers for $10,000. That's a big number. Don't I have to depreciate? No, because each computer costs $1,000. It's under $2,500. I just write it off. It's an office supply. And so that was huge in our world, because that pulled any controversy out of all of these small items off the table. And so there's no more argument. We don't have to capitalize, we don't have to worry about it. Just make that election and be done. And so that's really simplified things a lot. But if it costs more than $2,500, how do I write it off? And so, as in your world and my world, we are all considered a small business, because a small business for this Section 179 write-off, I think, is again on an inflation factor, but it's somewhere around $2 million, I think. And so if I don't buy more than $2 million worth of equipment in 1 year, that means I'm a small business. So I'm a small business, you're all small businesses, we're all small businesses. So I have this Section 179, and the Section 179 says that I can elect anything that I capitalize that's got a class life, don't get hung up on that definition, I'll talk more about it, of 20 years or less, I can just write it all off upon my election. Then on top of that, we also have bonus depreciation, which was phasing out, but the big beautiful bill put it back up to 100% permanently. And that says any business can take 100% deduction in the year. And so, okay, well, who's that? Why is that big? And why is there two provisions basically the same? Well, they overlap for us because we're small businesses. But Exxon can't take Section 179, but Exxon can take bonus depreciation. And so that's important. So literally anything you, me, anybody in the service industry, you can write it all off in 1 year. And so again, we're not really worried about the capitalization rules so much because we can take it if we want. And we've already talked about the auto limitations. So I guess the moral to the story is I don't see any reason why anybody in this room is going to stretch something out over time. Now, just a little aside, forget what business you're in, let's talk about your clients, and spend a little time there. And so when I'm selling a business property, there's a big difference between residential property and commercial real estate. And so when I buy a rental house for residential use, that is the class life that I mentioned of that is 27 and a half years. So if I buy a rental house, the building is going to be written off over 27 and a half years. And there's some limited exceptions, but by and large, you're going to have to depreciate that, and there's no bonus depreciation, there's no Section 179 available for a 27 and a half year property. I'm just going to have to write that off straight line over the life. Again, that's not, you know, I have people all the time that say, hey, I had a big year, I'm gonna go buy some real estate, and that's my tax shelter. Well, not if it's a residential house. That's not gonna work, because I don't get a big bang for my buck when I buy residential. The whole world changes when it's commercial. And so commercial real estate, and again, tax law, if anybody comes to me and says, well, that doesn't make sense, well, you can't apply logic to tax law. Okay, that's a waste of your time, a waste of my time.
Mm-hmm.
There's always a purpose behind something. And the purpose behind what I'm getting ready to talk about is an economic stimulus. And so how do I stimulate things like, and Easton, as I tell, is the primary example in my mind of what Congress was trying to drive and successfully did it. You know, Easton, and I grew up in Denton, I've been in Easton all my life. And there was a period of time when Easton was getting a little run down. Denton was getting a little run down. And you got all of these buildings that were built, you know, 40, 50, 60 years ago that doesn't make sense necessarily to fix those buildings up. It makes sense for me to rent a spot out in the new shopping center outside of town. That makes more sense. Well, it makes more sense until you pass bonus depreciation, and then you have qualified real estate. So what's that? So in the case of, and again, why I say Easton is the poster child, if I buy a commercial building, as we used to call it, the old Coca-Cola plant on Bay Street, if I buy the old Coca-Cola plant, and it's more than 3 years old, obviously, anything I do inside those four walls is a qualified real estate improvement. Okay, nice. What can I do with a qualified real estate improvement? Because commercial real estate is supposed to be written off over 39 years, even more than a residential. Well, qualified real estate, now the life is 15 years. And so anything I do inside those four walls is a qualified real estate improvement, and it's 15-year depreciation, but what about 100% bonus depreciation? That applies to 15-year property. So all of these buildings in Easton that have been rehabbed, anything that happened inside those four walls, you could write off in year one. And so that's why it all makes sense that downtown Easton, downtown USA anywhere is on rebound commercially, because I can write all of that stuff off in year one. And so that's why this restoring bonus depreciation, which was phasing out, was should be, in my mind, in your industry, a huge deal. Because now all of a sudden, rehabbing commercial property is a big tax shelter. So anyway, sorry, so I took that little aside to get off topic a little bit, but anyway, that should, and I've got a meeting with somebody tomorrow. Businessman's having a great year. He's talking about buying real estate. So what's the advice gonna be? Well, it's not just real estate, it's certain real estate. It's gotta be commercial. It's gotta be more than 3 years old. You gotta get the work done in the year. We're in November. Am I gonna get that done by December 31st? No, I'm not. And so, that ship has sailed. But it hasn't sailed for 2026. And so, anyway, that's just a side note. Next slide, please. All right, health insurance. Again, big topic for you, for me, lots of my clients. So health insurance is, you're a self-employed person. Self-employed people can take health insurance. They don't need itemized deductions. They don't have any of the medical limitations that they would otherwise have. And you can take it, what we refer to as above the line. When we say above the line, that means it's not an itemized deduction. We're gonna get it without limitation. And so the only limitation, again, is your profitability. Which in your business, my business, not a big problem. I'm probably gonna be able to take my health insurance as a deduction and get a benefit for it. When we talk about organizational structure, we're gonna talk about S corporations. There's a very specific way you have to do that in an S corporation, and we'll talk about that when we get to it. Anyway, probably something for your accounts to worry about, not you. Next slide, please. Retirement plan, another hot topic in your world. Normally, has anybody here got employees other than themselves? Okay, good. Didn't think so. Okay, so these are really the three buckets, if you will. And so when I talk about retirement plans, what I'm saying is, I want a deduction today. I want to put this money away for my future, and I want a deduction today. And so one thing to realize about retirement plan contributions is they are a deduction for income taxes, but not self-employment taxes. So a lot of you who are operating your businesses as a sole proprietorship, when I make my $10,000 retirement plan contribution, I'm gonna save on my income taxes, but it's not gonna save any money on my self-employment tax. Because I have to pay self-employment tax at some point, and I'm not going to pay it when I take this money out. So I pay it up front. So it's just the opposite of income taxes. Income taxes, I get the deduction now, but I have to pay them back in. And so we got individual retirement accounts. Well, okay, well that just says if I've got $7,000 of earned income, or my spouse does, you can borrow from each other, if you will. As long as the two of you have enough earned income, then I can take the deduction for a regular IRA, and it doesn't have anything to do with my business. Anybody can do that. But lots of limitations on IRAs, income limitations, those kind of things. Again, my spouse's counts, so even though I'm self-employed and I have my own thing going on, but my spouse works for a company that has an insurance plan, a retirement plan. And so if you look on your W-2, there's a little box right in the middle that says retirement plan, and if that box is checked, that's gonna throw some limitations on you. And so you say, okay, well, I wanna get around those limitations. What else can I do? So then we have the SEP plan, and what the SEP plan basically says is I can take 25% of my, whatever I made, and I can take that as a deduction for retirement plan contribution to my SEP plan. That's adjusted for self-employment tax. So the way the math really works is, if I'm a sole proprietor and I make $100,000 and I do this adjustment for the self-employment, it's actually 20%. So if I got $100,000 net income from on my Schedule C, I can take a $20,000 SEP plan contribution and take that deduction. And you say, okay, well, that math is fine, but I didn't make much money this year, but I still want to put more money in. The simple IRA has a different formula. And that is, I can put the first $16,500 in. So if I make $20,000 in the year, how much can I put in my SEP? I can only put $4,000 in my SEP because it's 20% of $20,000. In the simple IRA, I can take the first $16,500 and take it immediately. So I made the same $20,000, but I can get a $16,500 deduction in a simple. And so you have to kind of match up to what your situation is, as to what kind of plan is going to suit my income level. And then the solo 401k that we mentioned there in the middle, if you're a really high earner and you say, hey, I don't want any of these kind of limitations, solo 401ks really only work where there's only one employee, but that's you. And so solo 401ks, if I'm really making a lot of money, I mean, you can get a lot of money into a solo 401k, if that's what your primary objective is. And that's kind of beyond the scope of exactly what those calculations are. In fact, we don't do them. The retirement planning world has kind of evolved, kind of like health insurance has. You don't have an insurance agent that sells retirement plans and health insurance and liability insurance. You have a specific person that sells health insurance, and I have a specific person that sells retirement plans, because it's become so complicated, and that you pretty much need somebody that does that all day, every day. So I'm not going to get beyond that. Just know if you really have a lot of money, you want to put it away, talk to your investment person about a 401k, a solo 401k. Next slide, please. Okay, so we got about 15 minutes. And so we're going to get a little bit deep in the weeds here, but we're going to talk about the opportunities of other kinds of setups. And so, sole proprietorship, limited liability company, partnership, S corporation. So if I'm not a limited liability company and there's only one owner, I'm a sole proprietorship. So I put all my income and deductions on a Schedule C. From that Schedule C, whatever that net income is, I'm going to pay income taxes on that number, and I'm going to pay self-employment taxes on that number. No bifurcation, it's just simple math. It is what it is. But many people come to us and say, self-employment tax is killing me. And it does. Because again, there's no limitation. And so, maybe a bit cynical, but I'm not really depending on Social Security for my livelihood one day, because it's not a sure thing. And most investment people will tell you, for every dollar I put in the Social Security system, I'm going to be lucky to get the dollar back, let alone any return on the dollar. And so most of our clients in business say, I don't want to pay any self-employment tax. Okay, well, that's tough to get down to zero. But can we manipulate it? Can we manage it? Yes. And so one of the ways to do that is to be one of the last three. So let's talk about limited liability company, because I haven't actually seen a client incorporate in a long time. There's a very, very narrow window of people who actually become incorporated anymore. For the last 40 years, if I want some sort of business entity, organizational structure, I form an LLC. It's cheaper, it's easier. There's no things like board of directors and officers and all of those kind of things, and bylaws and minutes and all that stuff that comes with a corporation. Very simple, very easy. You can set it up yourself online, it takes about 5 minutes, easy to do. But now, what's the tax law for a limited liability company? Well, there isn't any. Because when limited liabilities came about, IRS said, ho, we are not writing a whole nother body of tax law. And so, what you do when you form a limited liability company is you pick what body of tax law you're going to follow. Am I gonna file a sole proprietorship? Am I gonna file a partnership? Am I gonna file a S corporation? All right, so, we're not gonna talk too much about partnerships because what do I have to have a partnership? I have to have more than one owner. Not many of your businesses have more than one owner. And so, we could talk all day about partnerships, but I don't think it's gonna apply to many people here. What you're really looking at is, am I gonna be a sole proprietor or am I gonna be an S corporation? Which one of those two is gonna give me a benefit? And so we've already talked about sole proprietorship, and we know that there's no limitation on self-employment income. How do we do that in S corporation? So in an S corporation, there's 2 ways to take money out of my S corporation. I can take out wages. Does that help me? No, because I'm gonna pay Social Security and Medicare tax on wages too. So has that done anything for me? Now it's actually cost me a little bit of money because now I also have to pay unemployment taxes. Not a lot, it's very little. It's in the hundreds of dollars, not thousands, but it's still more. I have to pay that. But alternatively, I can take dividends out of my S corporation. So what's different about dividend? Well, a dividend is subject to income tax, just like my sole proprietor is, but it's not subject to self-employment tax. And so, when I form an S corporation again, remember, pigs get fat, hogs get slaughtered. They say, oh, that's okay, I'll take it all out as dividends. That way I don't pay any Social Security tax. Well, IRS frowns upon that, you might imagine. And so we have this concept and it applies to partnerships as well. And again, we're not gonna get into that because we could spend 3 hours talking about that, and we're not going to. But there's this concept of reasonable salary. I have to pay myself a reasonable salary. Okay, well that's easy. Tell me what a reasonable salary is. Okay, so this concept has been around since the 1950s. And so we're working on, what, 75 years? IRS has had 75 years, Congress has had 75 years, the courts have had 75 years to tell us what in the world a reasonable salary is, and they haven't done it. And so, that's where opportunity rises. And we say, okay, how are we gonna determine that? And so, there are a number of factors. There have been court cases. In fact, there are now, I believe there's 13 cases up for appeal that are talking about this concept of self-employment tax and a reasonable compensation level. So even the courts drag their feet on this as far as giving us a definition. And so we're kind of tiptoeing around, keeping our eye on the courts to see what comes out of this, but right now it's kind of open season. And so we just have to feel our way through. And so what are the factors? Well, if I'm in a business that I have other employees, one of the factors is, well, I never want the owner or can have the owner make less than one of the other employees. In other words, I can't have an employee I'm paying $120,000 a year to, and my reasonable salary is 60, and I'm running the show. That's probably not gonna fly. But in your world, we don't have other employees. It's just us. So what are we gonna do? What are we gonna call it? Another rule of thumb is if I do at least 50% wages, in other words, my draws, if you will, that are not subject to self-employment tax in my wages, and I make that 50-50. So if I make $100,000 and I give myself a $50,000 W-2, and I take the other $50,000 out as dividends, legend has it, we won't get challenged. That's not official, it's not in writing anywhere. Have I ever lost a case or an audit where I did at least 50%? Nope, never happened. Never even been questioned, but did at least 50%. Is that the end all? maybe not again, you know, in your industry, I mean, I can make an argument. This year I sold 3 $10 million farms, and the next year I didn't. Well, I worked just as hard. I did the same amount of traveling, I did the same amount of advertising, I did the same amount of this. And just because I made $400,000 this year and I made $100,000 last year, why does my salary have to go up? I worked the same amount. I just got lucky. I did good. It all fell in my lap. Not to say that you don't have a skill level, I'm not trying to pick on you there. But still, anybody in sales is going to have that fortunate year and unfortunate years. And so, you know, my argument would be in the $400,000 year is, well, you know, we've been paying $50,000 for the last 10 years, worked just as hard, worked just as many hours, did everything I did. It just so happens I made $400,000 this year. Does that mean I needed a $200,000 W-2? I would argue I don't. And I'd argue that all day long. Now, should it be higher than 50? I don't know, maybe so. But the point is, there is a risk reward, and so what one client does might not be what the next client does, because the next client, who I've worked with for 15 years, and I know the scariest thing in their world would be a letter from the IRS to say they're getting audited. Whereas I got plenty other clients that say, bring them on, I'm ready. And so, you know, this is one of the gray areas, and anybody in the tax business, you know, there's gray areas in the tax law. This is one of those areas we do not have definitive guidance, we don't have definitive rules, we don't know exactly what we're doing. You do your best. And so some clients want to be super safe, some clients want to be super aggressive, and most of us are in the middle somewhere. So it's a case-by-case basis, but the point is, because remember, self-employment tax is 15.3%. So if I can save this tax on $10,000, that's $1,500. Okay, I multiply that by 10, that's a lot of money. I pick on my friends in South Dorchester, as my boys down there say, that's a lot of Budweiser. So, anyway, so we have a lot of folks in your industry that are S corporations. It's very common. S corporations work great where there's only one owner. S corporations work great in the service business. And so you guys are, in my mind, a classic industry that should be at least exploring that opportunity. Okay. So this is we talked about the self-employment tax. Go ahead to the next one. And then we talked about all that, sorry. Okay. So, if that clock's right, and you got me doubting that now, we still have a few minutes for questions. I'm here, like I said, I gotta leave here at 11:15, but I'll take any questions you have. So if there's anything that you have question on that would benefit the group, why don't we bring that up now? And if you've got something that really you don't think it would benefit the group, then we can do it after on an individual basis. Yes, ma'am.
Sometimes we have large deductions like to churches or to any nonprofits.
Mm-hmm.
If we make more, which we do with our income, can we put that as deductions from the business side of it rather than personal side?
You cannot. And so contributions are one of those things that are separated. And so, for example, we talked about health insurance. That's a special exemption that for self-employed people that says medical insurance is always deductible, but it's an itemized deduction on my Schedule A. And that special rule says, oh, if I'm self-employed, I can pluck that off that Schedule A and put it somewhere else. There's not a rule like that for contributions. If it's a charitable contribution, it's gotta go on Schedule A. It doesn't matter if I write it out of the business checkbook or the individual. And that goes for even larger business, even on your S corporation. If I got an S corporation and I take a charitable contribution out, there's a different line item. That doesn't go on box 1 where all my income is. That goes on another line that says, oh, by the way, this is a charitable contribution, and you gotta put it on Schedule A. And so there's no benefit to your business income by making charitable contributions. Now, again, we could talk for an hour on contribution planning on my Schedule A, but there's nothing from a self-employed person that's any different than anybody else. Yes, ma'am, you're next.
Two questions about the S corp. So if you're thinking about going to an S corp, when is a good time to do that? Like, you can't go retroactive anymore.
But you can.
You can, okay,
So-
so that's my first question.
Okay, so here's a reason that I tell, again, not just folks in this room, but in any kind of business, it's always handy to have an LLC. And so I encourage anybody who is committed to being in business, committed to self-employed earning style, form the LLC. I don't have to make the S election when I form an LLC because the default entity is sole proprietor. So when I form my LLC, by default, I'm a sole proprietor. And I can stay that way. Well, how do I become an S corporation? I file a form 2553. And so I just file that with the IRS and says, I'm an existing LLC, and that's why it's important, because I can't go retroactive on an entity that doesn't exist. I can only go retroactive on an entity that is in existence, and I can only go back to whenever that was formed. But we're sitting here in November, and I have a client come to me who started his LLC 4 years ago, but has never made an S election. He comes to me in November and says, oh, by the way, forgot to tell you, I made a big contract this year. We've quadrupled our income. Maybe you should have told me a few months ago, but that's okay. You can make a retroactive election back to January 1. As long as I had an LLC in place, I can go back to January 1. I have to give them a reason for being late, because normally I have to make this election within the first 3.5 months, 2.5 months of my tax year. So normally, if from January 1 and I want to file timely, I have to make that election by March 15th. Well, we're in November, it's too late. There's a revenue procedure that says, oh, but wait, you can go all the way back to January 1 or any date where the tax return hasn't been filed yet for that period. Go back and say, hey, we screwed up. My accountant and I misunderstood. I thought my accountant was gonna make the election and he thought I was gonna make the election. And so it didn't get made. And so you say, well, that's kind of wishy-washy, but actually they tell us wishy-washy's okay. What do I have to do? I have to look like, smell like, taste like an S corporation. Well, how do I do that? I pay myself a wage. I give myself a W-2. I intended all year. Well, wait a minute, it's November. That's okay. They don't know what time of year you paid your wages. We're gonna give you a bonus on December 5th for $100,000. Okay, pay my taxes, file it away, file my S election, say, look, here's my W-2. I acted like it's S corporation, and it flies. So you can go back, but you have to form the entity. So, and that's why anybody who's young and committed to this industry might say, I know it costs $300 a year, but maybe that's a good investment. Because once you form an LLC in Maryland, because of we all get the grace and glory of living in Maryland, so that means anything that we do or look the other way, we're gonna get taxed on it. And so the same thing with an LLC, you're gonna pay a $300 fee to keep that LLC in good standing every year. And so, anyway, but that's, once you get it formed, of course they charge you to form it, once you get it formed and pay the $300 a year, I'm good to go. You said you had two, was that two questions?
No, that was one, but my second question is, okay, now you're an S corp and you're talking about what wages versus your dividends. You're
Yep.
going to take the percentage-ish. From what I understand, you're saying 50-50 is gonna be safe pretty much all
Yep.
the time. Now, so what do you do on those years when you're like, you take 50-50, but next year, I guess it'll depend on the person. Do they
Well,
throw
so-
up red flags if you change it every year?
No.
That's my question. like what
Well,
that percentage would be?
The first comment on that is, and this will change someday, but for now, IRS's computers do not have the ability to compare my tax return this year with my tax return last year.
But
So
then we
everybody
have
always
AI.
says, is there inconsistent, but I'm inconsistent. They don't know that.
Okay.
They have no way of knowing that.
Huh.
They know what yours is compared to their test group,
Yeah.
but they don't know what your 2024 compared to your 2023 is. And likewise, the other little ace in the hole here is, they don't know when I paid my wages throughout the year. So we've got 100 clients, me being one, that don't pay any wages all year. And we get to December 1st, look back, in your industry, it's pretty darn easy. December 1st, you probably know what your commissions are gonna be for the rest of the year.
Yeah.
And say, okay, this is what my net income's gonna look like. Okay, let's see, what are we gonna do for wages this year? We've had to modify that a little bit, because IRS has come out and they now frown upon quarterly tax returns with zeros on them. And so what we've done with the help of QuickBooks Online is, set folks up in that situation, and we pay them $100 paycheck each month. And then we do the big one in December. So. Okay,
Thank you.
any more questions for the group? Okay, well, thank you very much. I'll stick around
Thank you.
5 minutes or so. If you have questions, the young ladies can help you as well.